All right, everybody, let's go live. So today I'm going to be talking about how to use an insurance policy to build wealth. And this is something that I've been teaching a lot of people how to do. And I love teaching this because it is introducing people to new topics. That's the thing. Becoming wealthy, sometimes it's a matter of hard work, but then other times it's a matter of knowing better ways to do things so that you don't have to work so hard. Or if you do like working hard, you get to combine working hard with working smart. Working hard alone is not enough because I'm going to guess that you guys work plenty hard. You're just not where you want to be financially because there's something different. What is that thing that's missing? Why is it that it seems like everybody else is getting ahead but you? And so I'm going to be showing you guys today how to use an insurance policy to help you build wealth so that you're not just working hard, you're working smart as well. And if you guys have any comments, any questions, feel free to put it in the chat and we can respond. This is live. This is interactive. If you have a question, I can answer it right on the spot. So today I'm going to be going over how to use the insurance policy, like I was mentioning, so that you could build more wealth. All right, so let's see. Let's see how. Oh, here we go. Perfect. So here is an insurance policy that is for a 38-year-old male. And it is where you put away $12,000 a year. So I'm going to start with this screen. I want you guys to start to understand a few things. Actually, before we do that, let's talk about why you may want to do this. Well, it's because there's three different things that this policy can do. It is a little, how do I put this? It's like a savings account that hides money for you, and it protects your money, and it grows your money, okay? So it grows your money. I'll say it again. It grows your money. It protects your money. It hides your money. And what do I mean by that? It grows your money because while the money's in there, it is growing passively. The insurance company is making it grow more and more and more. So that's number one. Number two, it protects your money. It protects your money because if you were to get sued, that money is in there and nobody can touch it. It's a crazy thing. And why they can't touch it is because it hides it. Technically, the money that's in there belongs to the insurance company, but you, as the wealthy individual, you have full control over it. People love the idea of having control over everything, but owning nothing, meaning you don't own the money, but you have full control over it. It's a crazy concept. And so this is the first time you're hearing about that. You don't quite understand it. But again, you have full control of the money. You don't own the money. A lot of people like this idea with real estate as well. You control the real estate. You don't own the real estate. The LLC or the S Corp owns the real estate, but you control the company. Here, the money is owned by the life insurance company, but you have full control over it. So this here, it's an amazing thing because it grows, it's protected, it's hidden, nobody sees it. It does wonderful things. The second thing that this policy will do is it's going to be like a Roth IRA. Some people call it the rich person's Roth IRA. They call it that because rich people often do not qualify for Roth IRAs because there's an income limit. If you make too much money, you cannot put money away into a Roth IRA. So this here has no limitation based on your income other than you might make too little money. But if you make a lot of money, this is great because you can put away 25% of your income into a life insurance policy. And when you take the money back out, and let's say you want to do it for retirement, you do not have to pay taxes on the money that comes out. You will pay money on the money that goes in, just like a Roth. You pay taxes on the money that goes in, but when you pull the money out, all of the growth, everything that you put in, you take it all back out completely tax free. The other cool part is you do not have to wait until you're 59 and a half if you don't want to. You may access the money now. You don't have to wait until you're 59 and a half to access the money. So it's a really cool feature, okay? And then finally, everybody knows, but life insurance has a death benefit. This is no different. This policy still has a death benefit. So when you pass away, whether your estate, your trust, or your heirs will get the money. So this policy that I create will have all of these features, all three of these features, right? So now let's look into a policy. Oh, let me do this one last thing. So you have to make sure that when you're dealing with somebody who's doing a life insurance policy for you, that they're setting it up the right way. A lot of times, and this is where I see people go wrong all of the time, is where they deal with an agent who is not necessarily on your side. And what do I mean by that? They are setting up a policy for you, whether they know it or not, where they do not maximize the cash value. The way I set them up, I have 70% of the money that you put into the policy go into the cash value and 30% go into the death benefit. Most agents that I ever deal with, they have it flipped. They have 70% go into the death benefit, 30% go into the cash value. Try to guess why they might do that. Did you say because of the commissions and that they get a higher commission based on how much death benefit they sell you? That's the answer. Now, the other reason why they might do it that way is because they don't know any other way to design it. They only know that way because the person that educated them in life insurance told them that's how to do it. And they told them that because, again, it's the commission, it's commission heavy. I'm not necessarily doing this for the commission. I'm doing this to help you become a better real estate investor. All right, so let's go into the next thing. Here is what a policy looks like. So let me zoom in a little bit. So this is $12,000 a year for a 38-year-old male. So what I want you guys to focus on here is the cumulative premium outlay, meaning how much money you've put into the policy. So every year you put in $12,000. Year number one, you put in $12,000. By year number two, you would have put in $24,000, $36,000, $48,000. By year five, you would have put in a total of $60,000. Now, if you go into the cash value side, you will see that in year one, you have $9,000 in cash value, $9,471, and it goes up to $58,174 by year five. Year six, you are a little bit ahead. Year 7, 8, 9, 10, and it snowballs. Look at this. Right here, you have $180,000 in the policy. You have $244,000 in cash value here. Here, you have $240,000 invested in the policy. Over here, $381,000 in cash value. Now, the thing is, most people forget there is a death benefit. So if you want to look at this, I guess based on a structure standpoint, look at it this way. Let's pretend none of this here existed. The only thing that existed was the death benefit. So if you gave $12,000 a year, right? $12,000 a year. And like I said, 70% goes into cash value, 30% goes into death benefit. 30% of the 12,000 is 3,600, I believe. That means you're paying $3,600 a year to buy this ever increasing death benefit that is for the rest of your life. If you consider the alternative, which is term insurance, most people have term insurance. That's where you're paying into a policy, but it has a term of 10, 15, 20, 30 years. After that, though, it goes away completely. This policy, though, does not ever go away. It will be with you until you die, whenever that might be. I am starting to meet people, because I'm in the industry now, I am starting to meet customers who tell me that they've been paying into their term insurance and it's about to expire. It's about to go away. They're like, oh, I've paid into it for 20 years and now it's done. And now I'm no longer covered. But obviously they didn't die because we're having the conversation. And I am glad that they lost that bet because that means they didn't die, right? So I'm glad they lost that bet. But that means there is no more coverage and that all of the money that they paid into that policy was completely wasted. This will cover you for sure. It will be there when you pass away. So Again, $3,600 goes here, right? Because this is a like, think about it as like a term life insurance policy that you're paying for. And then over here is your secret savings account. So then 70% of 12,000, that's like 8,400. 8,400 is going into here. So you think about it, by year one, you're already ahead. You're putting 8,100 in, you get 9,471 in value. This column here shows you how much it grows by. Year one, it grew by 9,471. Year two, it's growing by 10,374. Year three, 11,550, right? You guys see the growth here? Every year, you're putting in 8,400, and this is the return you're getting each and every year. So you're getting this return in your special savings account here. And over here is your ever increasing death benefit. Okay. So I'm just going over the mechanisms, and then I'm going to show you how I use the policy. So it's ever growing. So let's say I got to year 5. I have $58,000 in it. What do? How do I use this policy? Well, here's what's cool. I'm not going to pull the money out of the cash value. I'm not going to pull it out. I'm going to take what's called a policy loan. I'm going to borrow the money. So let's take a look at how it looks if I were going to use this. So here's my cash value, and I want to buy this property. This is an investment property. I want to buy this property. I'm going to take a loan out against the cash value. The reason I take a loan out as opposed to taking the money out is because I don't want the money to stop compounding. I want the money that I put in working for me. I want it working, chugging away, chugging away, chugging away. I take a loan, and the loan is collateralized by the cash value. It's like, hey, lend me money, insurance company. Give me money as a loan, and I'm going to guarantee your position with the cash value that I have. The insurance company is like, okay, you are guaranteed, you're always approved. Fantastic. So I take the loan against the cash value, right? Here's the cash value. I take a loan against the cash value, and then I combine that money with a hard money loan. So let's pretend like I borrowed 20,000 here, and I got a hard money loan for 80,000. I put the two together. I buy the house. The house is a rental property, and I take the cash flow, right? But now I have to pay these things back. I then go to a bank and I refinance. And when I refinance, I pay off the hard money and I pay back the cash value loan. Ta-da, right? Or if I'm doing a flip, instead of doing a refinance, when I sell the property, the proceeds from the sale go to paying back these things. Here's what's really nice. I do not have to pay back this loan in any kind of increment. I don't have to make monthly payments. I don't have to make yearly payments. I don't have to make any payments if I don't want to. I don't even have to pay it off at all. If I want to leave that loan forever, I can. Okay? So I'm taking a loan against a cash value. I don't have to pay it back at any specific structured schedule. I want to, though. And the reason I want to is if I need another loan later, I cannot take out more loans if I already have all of the money out. I can take 90% of the cash value as a loan. So if I take the loan out, let's say I take the loan out for, if I have 100,000 and I take out $90,000 as a loan, if I don't pay it back, there's no more money to borrow, right? There's no more money to borrow. And if there's no more money to borrow, then I've kind of missed the point, right? So I want to be able to borrow money again in the future. So how do I be able to borrow the money again? I make sure I pay back the loan. But they are not going to chase you down for the money. So if you're doing a flip or a rental property, either one, in the construction phase, you are not making any money, right? Money is always just going out of your pocket to pay for your rehab, right? To pay for your materials, to pay for utility bills, to pay for your contract. just to pay for whatever. Everything's just going out when you're doing an investment property. So if you can have less money going out because you're not paying the loan against your cash value, then that helps you in terms of a cash flow perspective. And then when I am done the deal, I refinance or I sell the property and I pay off all of these loans. And then I just have to pay the bank, just like a regular real estate deal. Now, this is how I would use this as a real estate investor. And again, why I care to do this at all, and why not just have my own money? Why not just use my own money? Well, it's because the growth in which I get to experience from putting my money away in this life insurance policy. So I want you to take a look, right? So like right here, I put away 240,000, but in my policy, there's 381,000. Like there's so much more growth, and that growth is occurring passively, which is a really, really nice thing. Meaning I don't have to do anything. I don't have to tell the holder of the money what to do with the money. All right. Now let's fast forward, right? Let's fast forward to a whole bunch of years in the future. And let's say I am done. I am tired of doing work. I'm just like, okay, time to enjoy. So here at the age of 71, I have put away $394,000 into this policy. In the policy, though, I have $924,000 in cash value. So I am going to treat this thing like a Roth IRA now. For the first 5 years, I'm going to pull out the money that I put into the policy. So this 394, I'm going to pull this money out first. When I pull out my contribution, I pull it out completely tax-free. Okay. So all of this money for the first 5 years, I pull out, which is the contribution that I put into the policy. Moving forward, year 6, 7, 8, 9, 10, 11, all the way down, I'm pulling this money out as a policy loan. Remember how I told you you can pull out a policy loan and you don't have to pay it back? Well, that's what I'm going to do here. I'm going to pull out the money as a policy loan and not pay it back. And then I'm going to not pay it back all the way until the end. And what happens at the end is I die. Okay, so now we don't know when we're going to die, but this is expecting that we're going to die. So when I die, I don't pay back the loans. I don't, but the loans do get paid back. And how they get paid back is from the death benefit. So I had this ever increasing death benefit. So if you look, my death benefit got up to $1.8 million. It started at like 500 something thousand. The death benefit grew to 1.8 million. And then I pulled out all of this money. This is like 1.2 million or 1.3 million. I forget. I did the math before, but I pulled out like million something. I only put in a little less than 400. I'd pull out a million something. And then I pass away. I use this money while I was alive. And then the death benefit gets reduced by how much I borrowed in terms of policy loans. And then whatever is left over goes to my heirs or my estate or my family bank that I create or whatever I choose, right? So there's still some death benefit money left. I took all of this money out while I was alive. So this is my retirement account. While I was alive and younger, I was using it as my piggy bank for my investments. And all of the while, this money was hidden and safe from creditors. And all of the growth that I've experienced, right? So you see right here, right? I put the money in and it grew to 950,000 or whatever. All of that growth, I got to use completely tax-free. Crazy stuff, right? So I know I just went over a whole bunch of stuff. I went over a whole bunch of stuff. Um, this is one of those things that if you have a conversation with somebody, they might not know what you're talking about. But if you talk to somebody who knows what they're talking about, like me, and I explain it to you, and then we have another conversation, and then I explain it to you again, and eventually, if you keep hearing the message described the way I'm describing it, it clicks. And then when it clicks, you see the magic, and then you see all of the different ways that you get to use these policies to help you get rich. And that's the thing. Wealthy people have been using these policies for years and years and years to build wealth. It's the middle class and the poor, they don't use these policies to do the same, not because they're not allowed, but because they don't know that you could do what I just showed you. They don't understand this stuff. They don't see the benefit, don't really understand the benefit. They can see it and they go, oh yeah, it looks good, that sounds great, but, and it's the but that holds them back. And if they don't do it, they don't get the benefit from it. Some people say, oh, home, this is cool, but I have a self-directed Roth IRA. That's what I do. That's what I do personally as well. I have an insurance policy. I have a self-directed Roth IRA. I have all of these other policies, right? I have all of these things because it depends on the situation at hand, which vehicle you use. And if you don't have this policy, if you don't have a life insurance policy, you've just eliminated one of the options to use to build wealth. One is not necessarily better than the other. They all work differently. And your job as a financially literate person is to learn as much as you can about all of the things that exist out there for you and then implement them in your life. The tools are there. It just is a matter of whether or not you're using tools the right way. If you use the tools the right way, you get benefit. If you don't, then you don't. So this is just one of the tools that rich people use to grow their wealth, protect their wealth, hide their wealth, and leave their wealth for generations upon generations upon generations upon generations. This is how you create that old money. This is how you create that generational wealth. This is a tool that will help you in your quest of building a fortress of money for your family. So it's just a tool, not to be judged. If you learn how to use it, it will help you. But if you don't know how to really use it effectively, then you may not be interested. So that's all. Your job, learn as much as you can and apply it to your life. All right, guys. Well, that is it. If you need to chat with me, feel free to email me at hone@honesloans.com. There it is at the bottom, hone@honesloans.com. That's HOAN and then at HOANSLOANS.com. Hones Loans. All right, guys. See you later.